Welcome back to Squawk on the Street. Let's get to our ETF Spotlight and go to Brian Sullivan for that. The focus, oil.
Yeah, surprise there, David. Hey, good morning, everybody. Thanks for joining us. Listen, let's talk about oil because a lot has been made about oil's recent pump higher, okay? I mean, gone from negative 40 to 24 and change on the current contract. And you've seen some of these oil stocks, look at that ETF, bounce off its lows of a couple of days ago. But the market has got to be very careful here to not get ahead of itself. But let's answer the first question. Why is oil at 23 or 24 bucks and not at negative 23 or 24 bucks? A couple of very basic reasons. Number one, all those fears about storage being full, they have dimmed just a bit. They're not over. There are still some concerns, especially with more oil at sea coming, as we have pointed out. But in the near term, in Cushing, Oklahoma, where that contract for delivery is based, those fears have dimmed just a bit because demand slowly picking up. Not a lot. If you look at traffic data in Atlanta and Houston, two states that have reopened, right, their main cities, we're not seeing a big jump in traffic, a little bit, but enough to maybe drain gasoline supplies. And of course, the supply cuts, guys. You've got OPEC Plus, G20, and Exxon, Chevron, ConocoPhillips all announcing cuts. U.S. cuts believed to come in more than 1 million barrels a day right now. That's just among the big 3 or 4 super majors in the United States. You factor in sort of everybody down the line. Rig counts, new drilling rigs have declined for 7 weeks in a row. So demand slightly up, supply down. That has firmed prices to 23.5 bucks, David. But hard to believe that we would ever talk about 23 and change for oil as a good thing. But I guess compared to negative 40, it is. But nobody's making money at these prices. Let's be clear.
That's what I was going to say. Better than negative 37. By the way, though, on that note, I mean, those who took delivery, if they did at that point in time, and found a place to put the oil, I guess are in a good position right now. If you could find a place to put oil, you may have been doing pretty well taking delivery, right, Brian?
Yeah, I mean, you're exactly right, David. I mean, and I guess it just depends on what you pay for that place to store it, right? I mean, super tanker rates were $25,000 a day. If you and I, David Faber and Brian Sullivan, to rent a super tanker just to have a party offshore, it would have been $25,000 a day. Now it's $200,000 to $250,000 a day. So you may look smart storing it for a while, but eventually it becomes a negative cost trade, negative carry, if you will, to steal a bond market term, where you're now losing money. So it's all about what you paid and how long it is before you put that oil back onto the market. I mean, to be clear, there's no real sign of a demand uptick. I mean, we talk about reopening. I get it, and that's great. But the reality is most of us are still working from home, and we're simply not driving. I mean, the last time I put gas in my car, I think was mid-March or something like that.
Yeah, it's been a while, and it doesn't cost much to fill it up either. Brian, thank you.
Nope.
Brian Sullivan.
Sure.